Hello, I'm Mark Fleming, the Chief Economist at CoreLogic, and welcome to our Summer 2014 Housing Update. As we've talked about in other segments, with housing demand being down and the volume of home sales growing ever so slowly, the rise in interest rates that's happened over the last year and a half has depressed refinance activity. We want to ask the question today is, will 2014 be a trough year for the mortgage market? When we talk about the rate increases, it's important to look at the active stock of mortgages. In this chart, we're showing all active mortgages in the United States today and the different rate buckets that they're in compared to a year ago. You can see that all the refinancing that has happened over the last few years has put a large share of the total stock of active mortgages into interest rates of 3.5%, 4% to 4.5%. If we take a going interest rate of roughly 4.25% to 4.5% today and add about a percentage point for the cost of fees for doing a refinance, typically you could roughly estimate that people are in the money only if they have an interest rate of above 5.5%. That means everybody below 5.5% is what we call out of the money from an interest rate or refinance incentive perspective, and you can see in this chart that that's probably half to more than half of all mortgages today. On the top right tail, there are some high-end mortgages with higher interest rates, but those are likely to be subprime loans that don't have access to available credit. So there's a very, very small segment of the active mortgage stock today that's really classified as in the money from a mortgage perspective. And we see the result of this in the trends in refinance shares. You can see historically over the last few years from the surveyors and forecasters for the mortgage market, Fannie Mae, Freddie Mac, and MBA are shown here, that the refinance share has been relatively high at around 70% for the last couple of years. A typical market is probably predicated on more like a 30% refinance share. So we've been living off a lot of refinance activity in the mortgage market over the last few years. As interest rates rose last year and have slowly moved up to around over the 4% mark this year, you can see refinance activity has dropped off dramatically. Currently are in the 40 to 30% range depending on who you're looking at. And expectations for 2014 and 2015 show an even further decline in the refinance share as rates are expected to modestly rise. It wouldn't be unsurprising to see a refinance share of only about 20% of all mortgages in 2015. What does this mean for total originations? Well, you can see that we had originations around $1.7 to $2 trillion in 2013, and the drop-off in refinance activity has created a much smaller market for 2014, just only a little bit over $1 trillion, somewhere between 1.1 and 1.2, and some are estimating it might only come in right around $1 trillion. But then we have growth, ever so slow growth coming from the purchase market in 2015, really intrinsic demand growth in the housing market driving an ever so modest increase in the mortgage market to maybe $1.2 to $1.3 trillion across the three forecasters here. So low, yes, 2014 likely to be a trough year. But let's actually evaluate a couple of different economic scenarios. Using IHS Global Insight baseline pessimistic and optimistic economic scenarios, you can see the likely outcomes to the mortgage market. Keep in mind here that an optimistic economic scenario is a GDP growth rate of 3.5%. If the economy is growing that quickly, we'd actually have to increase interest rates quite dramatically, and here it shows an interest rate increase of up to 7%. Well, you have a big increase in interest rates like that, you have even less refinance activity, and it actually reduces demand on the home sales side because of affordability issues, and you actually get a lower, below $1 trillion housing market. The good news here is that GDP optimistic scenario, 3.5%, I see as a very unlikely outcome. The long-run expected growth rate for the U.S. economy is only around 2% today, so even a 3% growth rate is actually a bit of a stretch for our economy today. What's much more likely is the baseline or even the pessimistic scenarios, which only have very, very modest rate increase likelihoods of around 4.5% to not even 5% by 2015. And under that scenario, you see very, very little movement in the mortgage market. So the optimistic scenario of economic growth might lead to a pessimistic housing or mortgage market scenario, but I don't believe that's a likely outcome at all. Once again, thanks for tuning in to CoreLogic's Housing Update. For more information, go to the Insights area of CoreLogic.com for our research blog and other housing statistics.